All right. Good morning, everybody. Welcome to Be the Market Expert, right? And I think let's kick it off this way. And if anyone participated on the regional call yesterday, we had our economic update, or whatever that looked like, I guess. And one of the things that got talked about was the housing recession, right? I think that it was like dun dun dun, and how it was presented. And I think that we have to keep in mind this is that the housing industry has been in a recession. Like it has been. So as we're thinking about 2024 and the things that are happening, we truly don't know what it's really going to look like and what we can assume based off of a lot of the data that we're going to be looking at and the data that we've been tracking, since we started this thing a couple of weeks ago, is that interest rates are going down. Inventory is ticking up slightly. We're also seeing mortgage applications tick up. And so we're going to see the housing recession, or this housing recession, kind of fade away. But I just want everyone to know, especially for those that were on the call, like we've been in a housing recession, like for almost 2+ years now. And so to have this conversation, I just want to put everyone more at ease, and like 2023 can't fall from the floor, right? So if we look at this thing, the housing recession is essentially over, and this is from Lawrence Yun, who is the chief economist from NAR. And really what it's just going through, and we're just tracking data. And again, what slowed down the housing market? Interest rates. And with higher interest rates, we do know what? We do know that most sellers traditionally become buyers. And we heard of this thing called the golden handcuffs. And with the golden handcuffs, we saw people with a 2 and 3% interest rate. They were not super inclined to go buy another house at an interest rate of 6 or 7%. And so they had these golden handcuffs on, and it slowed them down from entering into the market. It wasn't because people didn't want to buy. This isn't 2008, right? This isn't where you're going to be walking down the street and you're going to see 10, 15, 20 houses for sale, right? And I just picture this brand in my head. It was 4 letters, and it wasn't Enter, but it was, and like they had like domination and all these cheap properties, right? Like in Colorado. This isn't that. And so I just want to put everyone at ease. Like as we're thinking about this, the housing recession is essentially over. I just want everyone to know that as we're talking, as we're going through and we're looking at this data, and we're becoming the real estate economist of choice for our consumers, that there's a lot of things pointing in the right ways. So let's jump into it. And the very first thing that we're going to look at, right, that's what we've been looking at. And this came out January 20th. And today, we're on the 23rd. So this was, I believe, Friday. And again, this is where most of our data is coming from, is we're looking at the rear view mirror. And that's how we need to track data, because none of us have a crystal ball. And so we can forecast based off of dots that we're looking at. And we truly need to see what was happening the week prior. And that's going to be able to guide us on what we're going to be seeing in the future dates. So mortgage rates, inventory, demand rise as price cuts fall. All right, cool. So weekly housing data, this is national data, and it's Altos data. Most all the data that we're going to be looking at for now until forever will be Altos data, because they truly do go through and they break down what is going on in a national level. So here's a look at this week. And if we can see weekly inventory change from the 12th to the 19th, remember this came out on the 20th, inventory rose from 505,000 homes to 506,000. Not a huge increase, right? Like as we're seeing, we do know that we have seasonality. And with seasonality, we're seeing people thaw off, and they are open to the idea of to start selling their houses. Same week last year, right? So if we were to look at the same week in 2023, 473 houses to 472,000. So we actually saw a decrease this time last year in inventory. And then we look at the inventory bottom of 2022 was 240,000. And at the peak of 2023, we saw 569,000 homes on the market. Let's call it 570,000 between friends. And we'll see why that matters here in a minute. So we look at this graph, national single family inventory. And again, we look at 2019 data. because 2019 data is normal. We're going to call all 2019 data normal data. Remember, 2019 was normal. 2020, we had a pandemic. 2021, interest rates were at 2%. Money was free. We saw a pent-up demand plus free money. We saw a lot of people go out. 2022, towards the end, it started getting a little bit tougher because of interest rates, and we started to see it slow down. 2023, obviously, interest rates were super high, but in 2022, we just saw them go up so quickly. It scared a lot of people. It wasn't that they were super high. It was just the how quickly they went up. People are like, whoa, 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 what's happening? This doesn't feel right. And in 2023, we saw them high, and then we just kind of saw them on this roller coaster going up and down, like it was a third world country, and you couldn't trust what was happening inside of our banking system. So if we look at this thing, this is what it's showing. It's national single family data, 2019. And you can see 800,000 homes up to 958,000 homes. That's a healthy market, right? Like, this is the kind of data that we're looking for. And if we were to look just over, again, 2021 and 2020, right? We just saw it keep declining as we were going through the pandemic. And then 2021, things opened back up and people were starting to buy. Guys, this is unhealthy. This is super unhealthy to have this low of inventory. So as we're having conversations with our consumers, we need to let them know that, since 2021, we've seen all-time lows in inventory. And it started back in 2020. We started to see this decline in inventory as demand increased. But we've seen less sellers selling their houses. And again, it's because of interest rates, but this is super unhealthy levels of inventory. 506,000 homes for sale nationwide. It's not a lot of houses, considering that if we were to go back all the way to the 1st of January January 4th of 2019, 800,000. And then we scroll all the way over here, we're talking 500,000 homes, 300,000 less homes. This is an unhealthy market. Yes, Kathy.
I either missed it or didn't understand. How
Yes.
did you determine we are no longer in a housing recession?
Oh, so it's not that we're no longer in a housing recession. We're still in a housing recession, but we're recovering out of it. We're saying that we're pretty much at the floor and we're coming back out.
Okay, thank you.
Yeah. So for clarity, we're still in it. My whole purpose for opening up the whole conversation, and thank you, Kathy, for bringing that up, because obviously I didn't hit my point. My point was this: if you were on the call yesterday and you heard housing recession, I didn't want you guys to think that something's about the worst that was about to happen. Like, it wasn't getting worse from where we are. We are still in a housing recession. Now, what that doesn't mean that we can't see a job loss recession or something else come through here, but housing has been in a recession for north of 2 years at this point. We've seen a decrease, right? Like, you guys can see this. If there's no inventory, no one's buying houses, right? Like, we've been in a housing recession. Thank you, Kathy. So then as we're going through, let's look at the new listings data. And again, this is last week over the past several months. Again, rear view facing data. This is what helps us determine what we might be foreseeing going forward. So 2024, last week, 44,000 homes hit the market. In 2023, this time last week, 42,000, let's call it 43,000. And then in 2022, let's call it 43,000 homes again. So again, we are seeing a little bit more homes at the market, not significantly more. We're talking 1,000 homes over 50 states. Like, that's not anything huge to write home about. But as we're going through, these are what we need to be looking at. We are actually seeing more homes come to the market. And again, seasonality. We have to keep in mind that we're only in January. People are still thawing off. National data again, like, if we were to look at this, and this is what's interesting. Guys, we're at all-time lows. National single-family listings. Here we are, and we are looking all the way across. Like, this is low. And you can see this is just 2022 versus 2023. And again, this is February through December. So this is the last 2 years. And you can see that, like, at the height of 2022, 90,000 new listings came on the market at one time. And this is kind of where we ended it. Like, we are nowhere near having enough inventory for the amount of demand that we have. And this is what's keeping prices still elevated. Yeah, homes might be sitting on the market a little bit longer, but prices are going to stay elevated. And this is why this isn't 2008. Yes, we are in a housing recession for the last 2+ years. And as we're thinking about this, we just have to keep in mind that a lot of the things of why we're not going to go back to the big short, right, is because of this right here. There's no inventory. 2008, there was a ton of inventory. Demand and everything was changed because of the amount of houses that actually flooded the market. And this is why last week we talked about the silver tsunami, right? Where they're saying all these baby boomers are about to sell their houses or die, right? Like, and it was like we're going to get flooded right now. There might be a wave, but the amount of inventory that we need to hit our market at one given time. And so what the silver tsunami is going through and saying is like, all this inventory is just going to come crashing down and we're just going to have just an influx of inventory. Well, there's only way that would happen is if it all happened in the same day, same week, and then there was more options. But in all reality, we know that's not how this thing works. So we're going through price cut percentages. We're seeing less price cuts versus last year. So again, this time last week, we have seen less price cuts. So again, we're seeing more people come to the market and houses are coming off the market quicker. Now, with that being said, this is what we're also seeing. We're also seeing buyers be pickier as well. We are actually seeing buyers be more discerning as it's coming through and they're looking at houses and they are making sure that if they're going to pay 6% interest rates, that the home is still fitting their needs. This market's still about finding the motivated. This isn't 2021, right? 2021 was $100,000 over asking, waive all your contingencies, give away your firstborn child. This isn't that. As we're going through and we're doing these different things and we're having these conversations, we know that buyers are saying, okay, does this check all my boxes? Because I know that my payment, I'm going to be at the top of my threshold because of these 6% interest rates that we're still seeing. So here we go. This is just the price drop. And again, we're seeing less homes have a price drop as we're going through over the last 3 years, right? We're right in the middle. Now, 2022, 20%, 34% in 2023. So we're doing better than we were in 2023. Now, here's the good thing. Purchase application data. This is what we truly need to be tracking. Like, as we were having conversation, this is probably like the most exciting data that we could be looking at. And the reason for this is this is the data that says, do buyers have faith that now is a good time to buy? Are they calling their lenders? Are you guys giving referrals to your lenders, to your customers? And they're saying, hey, I'm actually interested in buying a house in 2024. That's this data right here. So again, we're truly working from the floor. We're working out of the basement at this point. Like, if anything, this graph is showing you, we are working in the basement. So any positive uptick, like it's going to show here. And so as we're looking at this thing, we can actually see that it is going up. We are seeing more buyers talking to lenders. You guys are giving more referrals to your lender partners, and people are trying to figure out what they can qualify for. This is a positive. This is saying that people are seeing positivity. They are seeing a reason to buy a house in 2024. Interest rates, right? We're still north of 6%. We're south of 7%. The Fed came out last year and said that they're not going to do anything to raise rates unless we go out, we spend like crazy, right? Like, because they're hawkish and that's what they like to do. Like, they see a little blip and they just like to instill fear in us and be like, hey, I told you once, stop spending money. If you don't stop spending money, I'm gonna raise rates on you guys. Like, that's what they're doing. That's their whole plan, because they want to be able to control inflation. And that's their way to do it, is by raising money to get us to stop spending. And it kind of worked back in 2023. I mean, we have some of the highest credit card debt that we've ever seen as a nation. But yet we did see the housing sector slowed down. That's why we went to this housing recession, is because less people were buying houses. But this is great data. So as we're going through and we're having conversations, like I'm probably going to be saying like, hey, we're seeing more purchase applications go up. We are seeing more potential buyers enter into the real estate space. And this is what is showing it. This is the actual data that is showing that people are interested. And then we just look at the 10-year yield. Like, we're not going to dive into this because this isn't that type of class, but we do know that there is a direct correlation, right? And then as we're going through, when the Fed is actually lending and more money or going, and there's the 10-year yield, right, where they're selling more bonds around the 10-year yield, that means that actually people feel like everything else isn't safe. And so they're actually putting more money into there, and we start to see rates go down. And then when people are going through and they don't see it safe, we actually see rates go up. That's kind of what this is looking like. As we're looking a little bit further, I just want to pull you over into this because this is actually almost the exact same data, but it's the exact same data and it's just written a little bit differently. So available inventory of unsold single family houses rose a little bit. Cool, we just saw that. That's 7% more homes on the market than last year. So same data that we just looked at, it's just written a little bit differently. So if you actually want to have a conversation, put this out on social media, be that real estate economist of choice, you can say, hey guys, we're actually seeing more inventory on the market. We actually saw 7% more inventory this year hit the market last week than we did in 2023. Inventory has been growing versus last year. Cool, whatever. It did say that the pace did slow down a little bit. Here's this. We only saw 54,000 new listings. What's also interesting is this. 10,000 of them have already been put under contract. All right, cool. So we saw 54,000 more homes hit the market as a nation last week, and already 20% of them have been put under contract. 20%. So as we're going through, guys, we're looking, and this is actually telling a story. So yeah, we're not seeing a whole lot of houses hit the market, and that's what's keeping prices inflated. But we also know that we're seeing more purchase mortgage applications go up, and we're seeing these houses as they're coming onto the market. They are 20% has come off the board already. 54,000, 20%, 10,000 homes left the market the same week they were put on. This is a good sign for agents, right? And for sellers, that there is an appetite for housing. We go through the growth of pace has slowed a little bit as well for pending sales. Obviously, that makes sense. There's not a whole lot of inventory. We can go through home prices. It says home prices are less volatile. All right, cool. So as it's saying, it says the price of newly listed cohort is at $399,000 right now, which is more than 5% above last year. Okay, so the national home prices are rising. We're seeing home prices go back up. And we are seeing price reductions. As the current rate of price reductions tells us that there are sufficient buyers for the current inventory and current prices at the current mortgage rates. Again, everything is attached to what my monthly payment is going to be. For the most part, people don't care 7, 8, 9, 10%. Like, that number doesn't mean anything to them. What they care about is their mortgage payment on a monthly basis. So what we're seeing is that just 31% of active market had a price reduction nationwide, and 80 basis points fewer than last week. So we're seeing that homes are not falling as quickly as they were. Also a good sign. But then again, this is why we talk about this stuff. So we're looking at it, guys, and this is one of the bigger points of this conversation that we're having every Tuesday, is to look at the mortgage rates. So if we look at the mortgage rates right now, and this is from yesterday, so you can see this hasn't updated today yet. So this is January 1st to January 2020, or the 22nd of 2022, from the 22nd. So as we're looking at this thing, we can see that we started the year off, right? We started the year off and we were somewhere around 6.651 for a conforming loan. And then for an FHA loan, 6.5. And again, we don't see the first because it was the holiday. And we're seeing this thing stay pretty much in line. Yeah, there was a little bit of a dip there, and then it started going back up on the 18th, right? We started, or I guess the 17th. And then as of yesterday, it closed out at 665 and 6479. This is what we want to see. We want to see it be fairly level. This is why the big issue that we see, and let's just talk about sellers. And again, we talked about interest rates, and that it slowed a lot of the seller demographic from entering into the market space, because why would I leave my comfort of a 3% mortgage rate? Well, here's the other thing, and it's the psychology piece of it. So as we're looking at this, and let's just go back to a year. Here's 1 year's worth of data in this roller coaster, right? And we can look at this thing. This is what you would expect out of a third world country, not the United States. And so as we're looking at this thing, this brought fear to sellers as well. And be thinking about this as a seller. Traditionally speaking, as a seller, I don't have $600,000 to go purchase a house. I need to get a loan. Well, I have to be able to lock in my mortgage rate. And to be able to lock in my mortgage rate, I actually have to identify a house, right? We pretty much know this, how this thing kind of works. And so as I'm going through and I'm doing this as a seller, and we know that what it looked like last year, let's be real, last year was not fun. Last year was fun for nobody. And so as we're going through and we have less buyers, because less buyers are not super motivated because of interest rates being at 6 and 7%. So there's less buyers. And so I wasn't super motivated as a seller to put my house on the market, because firstly, I would have to actually go find a house that met my needs. And if I didn't know what the interest rate was going to be in a week from now, 2 weeks from now, 3 weeks from now, what is the likelihood of me listing my home on the market? Because I could have ended up over here and be at a 7.83%. Guys, this is ridiculous. And so, and we just look, right? Like a couple of weeks prior, it says 7.6. A couple of weeks prior to that, a month, we're talking 7.2. And this was the uncertainty going through sellers' heads, as they didn't know what next week looked like. And if they were to put their home on the market, they actually might be homeless. Like they very well could be homeless because they could have got priced out of purchasing a new house. So this is what I'm talking about when I say third world country, is this, we didn't have any faith of what our money situation looked like in the United States. So that's why it's very important. Like as we go through and we're tracking data this year, this is what we want to see. This is fairly flat. This gives seller certainty that if they put their home on the market, that they're going to be able to go through and be pretty much safe in this space, as well as this is actually putting certainty in buyers that they're not seeing crazy rates hike up and down. And guys, this is where we kind of want to be anyway. I do believe that we do need to see interest rates still drop. Interest rates still do need to drop. And I'm not saying anything huge. I'm saying like maybe, 6.25, right? Somewhere in there, I think that we actually see more of a comfort level with our buyers, and we will see more and more people raise their hand and say that they are interested in purchasing. I am not in the camp of we need to see 2 or 3% interest rates. Firstly, that was a gift from God that we'll never see again. And secondly, that's what put us in the situation that we were in last year. So we do need to see less. We do need to see the rates go down. And I do think that's going to pick up inventory. And I think there's a lot more smart people out there than myself that believe that we'll see, closer to 6 by the end of the year. And we're probably going to level out. And by next year, around 5 something. And 5 something is going to be a very, very healthy interest rate that we're going to be at. But this is the story that we need to be telling right now, that we are in the third week. We are in the third week of January 2024, and we have seen pretty flat interest rates. So as a buyer, and that you're considering purchasing, like now is a good time. Like it feels safer than it did in 2023 to be able to go out and to go look at a house, because for the most part, the interest rates are going to be the same for when you find your house. it has pretty much stayed fairly level. And since it's staying fairly level, we can start the process today, get pre-approved, and you know that we're not going to see a giant spike in a couple weeks from now based off of what the map is showing us that we are doing currently. So again, like, and you guys can look at this, and this is just optimal blue, like as we're going through it, you can check this out, right? We can play with FICO scores, right? Like we can actually go through and see like what this thing looks like. You guys can look at VA, right? We can pull VA. You can see that VA is even a better rate. Jumbo loans are going to be a little bit higher. That one's fluctuating a little bit more just because of the amount of money that we're talking about here. So that one's pretty up and down. But for the most part, as we're looking at this thing, the two loans that we're really truly dealing with, even the three that we're dealing with, it's staying pretty level. This is a good sign. And then guys, Altos data. So I do like this. And so you guys all have access to this. You guys can Google Altos research and just look up market data, and you all have access to this. This is free. This is the free version. And you can either put in the zip code or the city that you're interested in. So I just did Arvada. And so again, this is data for today. This is updated. And it says this week's, the median list price of Arvada is 715. And again, so median data just means this. I took the lowest price point house, and I took the highest price point house, and I just kept working my way in, cutting them out. And whatever the middle number was, that's where I landed. So the middle number, after I take out all the outliers to the middle, $715,000 in Arvada is our median price point, which is kind of wild to think about. And it says this is an increase over last month's market action of 45 when we're talking about right here, this 47 number. So this 47 number is saying that we are right now in a strong seller's market in Arvada, Colorado. And there's a lot of things that go into it, and we're going to talk about it, but it says inventory has also decreased to 105 houses on the market in Arvada, according to the Altos data right now. So as we're looking through here, the market remains pretty stagnant, right? It says prices have not been moving higher for several weeks. However, inventory is sufficiently low to keep us in the seller's market zone. And again, if there's not a whole lot of options out there, that means that if you are one of the motivated and you actually need a house, or you've made the executive decision, right? And so we got to be thinking about this, the motivated. We have people that are dating that want to go move in together now. We have people having kids, they need a bigger house. And we also have the other side of things where maybe we're needing to right size, we're needing to downsize, we're actually having family leave. And I think that one's probably a little bit less motivating for people to actually sell their house with the interest rates that they're at, because they've already locked into something that's probably closer to 2 or 3%. But the people that are actually growing their families are going to be more of your motivated in this market right now. So less inventory, that's what's actually keeping our prices as high as they are. At $715,000 in Arvada, it sounds pretty high to me. So if we look at this thing, medium price point, we can see, right, like it kind of flattened out a little bit. It was going up, and now it stayed pretty flat for the last couple of weeks. Like it did pop up a little bit, but for the most part, 715. Median price point of new listings. Now this is going down. So this is saying like it was higher there for a little bit, February 12th, and then we're seeing less houses. So we're seeing that the median price point of new listings actually go down. Price per square foot has gone up a little bit. So if I'm thinking about this, and price per square foot is probably meaning that we're seeing smaller houses kind of hit the market. We're not seeing bigger houses when I see this price per square foot go up. Average days on market, pretty flat. Like this is actually pretty flat. We're seeing around like 3 months is what this is looking like. So our average days. So when I talk about averages, I'm taking all the numbers, right? I'm taking, 3 days, 4 days, whatever, all the way up to 92 at this point, I guess. And so I'm putting all the days in. It's probably actually closer to like 100 and something on some of these. And then I take them all in, I add them all up, and I divide them by the total, and that gives me average. So that's how we come with average days. So the average days on market right now is 92. Median days is 56, where I took out all the outliers and I worked my way into the middle. Price decreases, we're seeing it go down. We just talked about this, right? We talked about national data before this, and we can see that Arvada, Colorado is no different. We're seeing less price decreases, and you can see this kind of go, right? We saw price decrease of December 1st, 2023. So we're talking a month ago, like a month and 2 weeks ago, 54%, and it has just been decreasing more and more and more. We're down to 37% price decreases. Price increases, guys, this is just new inventory. When I started thinking about price increases, I think about new builds. And we know this, the new builds have slowed down. We saw this, we looked at this data. When we're talking about new builders aren't looking, they're not excited to go flood the inventory onto the market because they want to keep prices inflated. And 2023 was an awesome space for new builds, right? New builds was in a great position because firstly, they're their own bank. And so they get to control their interest rate. And secondly, they get to control the inventory market. So like 2023 was a great time to be a builder because prices were coming down on bill of goods and services, as well as they got to be the bank. And with interest rates being so high and there not being a whole lot of inventory on the market, like they won. So when I see this price increase, that's all I think about this is new builds hitting the market. They're not incentivized. They're going to keep their prices as high as and inflated as they possibly can. And so we're probably going to see less and less. And also keep this in mind. With the cost of money, right? Money's not cheap anymore. Money's not free. Like 2021 money was free. It makes sense. We're also going to see less apartments. We're going to see less multifamily getting built. We've seen the graphs. We've seen the application data for permits. It's less and less. And we've even seen the work stoppages as well. They are not incentivized because they're not making their money. So as you guys are seeing these news articles about how rents are falling or rents are staying stagnant, we have to keep in mind that when a company goes out and they build a multi-unit apartment complex and interest rates, they had to go get a loan, and interest rates are at north of 6%, and we're seeing a decline in rent dollar, it does not have people super excited to actually go and build these properties to get tenants. So we're going to see less and less multi-family units being built. Even though we're seeing some things go up, it's way less than what we need. Relisted homes, cool, whatever. I think the inventory, though, as we're looking at this thing, inventory has been going down. And then this is a little bit flat, right? We're talking, 116, 114, 105 over the last 3 weeks of this month, this year. So we're seeing less inventory hit the market. And again, this is why we're seeing the prices stay as elevated as they are. And again, seasonality. We're on the third week of January. Third week of January, we start to see people start to thaw off and we start heading into the spring months. And that's when we start seeing things get exciting. Here's median rent, right? And so I know I just told you guys that the rent is going down, but obviously in Arvada, that's not truly the case. And so it stayed pretty stagnant at $2,800. And then it looks like it kind of popped up a little bit in January, which also makes sense to me as well. Like people going in, and we see more competition in the first month of January as leases have ended, and we see that the prices increase, they're renewing. This is pulling some of that data as well. So that's what that looks like. And then your market action, it's a 47, and they're just basing this off of what it's going through and what kind of seller's market are we in. So we're going out of 0 to 100, 0 being a buyer's market, 100 being a strong seller's market. I think we were to look back at this in 2021, I think we probably would have been somewhere between 90 and 100, right? There was no room for negotiation. 20 plus offers on contracts. So this is where it looks a little bit different. And let's just pull in something else. Let's look at Westminster for fun. The Westminster is saying it's actually a little bit better of a seller's market, right? So if we look at this, and again, we're talking about median price point, 561. They're giving it a 51, so it's actually stronger than it was this time last week of a 49. Also less houses on the market, so they have even less homes on the market. But if we look through, their median price point's way less than ours, and so that should show you as well why they're selling more houses. right? Still less inventory coming on the market, but they have a better price point. So in Westminster, Colorado, 561,000 is their median price point compared to Arvada, which was what, 714 or 711 or something like that. And as we're going through, like that's going to be a big thing. And affordability is a real issue that we have in Colorado, right? If we talk about Robert Kiyosaki, he talks about frustrated money. We have frustrated money in Colorado. Our money does not go as far as it does in other areas. And obviously, even there's different pockets. When I start thinking about Arvada versus Westminster, and we know that like the further north we get and the further east we get, like prices traditionally start going down, right? Unless I go northwest and I land in Boulder, which is its own area completely. But if we look at this thing, 561, 535 is the median new list price per square foot, and they're pretty much staying flat. Yeah, they had this little bit of a spike back in the beginning of January, but they're staying pretty flat. Their median days on market's going up. And that's higher than it was in Arvada by about like 20 days, I think is what that is, or maybe like 14 or something. But the average days on market's a little bit less. We were at 90, they're at 80. Price decreases are going down. They're staying pretty flat. They did have a little bit of a spike in new homes being built, but it looks like it's dropping back off a little bit. Same numbers where we were at. I think we were both at 2%, Arvada versus Westminster. Inventory is going down. They have less inventory. And again, their median rent is still pretty high, just like ours. So this looks like this is pretty much the case for all of Colorado right now. So as we're going through, I think the story that we need to be telling about is truly purchase application data. We're seeing more people interested in buying and selling houses, or at least the buying side of things. This is telling me that you guys are referring business to your lender and people are actually having these conversations. They're saying 2024 is my year. What do I qualify for? So as we're going through, how are we telling this story? Because what we do know is this: interest rates, right? We talked about interest rates. And as we're looking at interest rates, here we are, they're pretty flat. There's a lot of people on the sidelines thinking that there's going to be something happening and interest rates are going to go lower. Let's just play out this scenario. Let's say that it does. No crystal ball. We don't know what's going to happen. We do assume that they're going to go lower. Interest rates go lower. And now let's say that they get to like 5.25, or I'm just not 5.25. There's no world they hit 5.25. Let's go 6.25. 6.25 or maybe even 6% sometime in Q2, Q3 of this year, which I think is pushing it, but let's just pretend. They get that low, what happens? There's more demand. And these are the conversations as we're going through and we're coaching people. We need to figure out what is their motivation. Why are you interested in purchasing a house in 2024? Because as I'm going through and I'm having these conversations with people and they're like, well, hey, we're increasing the size of our family, or we're working remotely, so we need more space, or, insert whatever here. As interest rates go down, we're going to see more hands go up. We're going to see this purchase application data go up. And as this purchase application data goes up and more people are getting into the real estate space, we need to keep in mind that there's still a finite amount of houses that will be on the market. So keep in mind, we're going to see millennials come back into the space. We're going to see Gen Z actually enter into the space. We're going to see people, motivated buyers for some kind of life circumstances, actually going to have them change houses this year. The first two options, those millennials and those Gen Zs, for the most part, they don't have a house. So they're only going to be taking homes off the board. They will be removing inventory. They won't be adding in any inventory. So as we're seeing less homes on the market and we're seeing two different demographics of people, of buyers coming in and removing inventory and not placing inventory on, we're going to see bidding wars. And I don't think it's going to look like 2021. God, I hope it doesn't look like 2021. But what that does mean is this. That means that as interest rates go down, more hands go up. And as those hands are going up, there has to be something that's going to differentiate them between the other two or three bidders on this home. And that is going to be cash out of pocket if we can't get an appraised value. So if we can't get an appraised value of what they're putting in for, that means that they are going to potentially have to go over what the home is worth. So if they're going over what the home is worth, that the bank doesn't lend that money. And that's the conversation that we need to be having, because I don't think people understand that. I think that the general public believes that if they go buy a house, the bank's going to loan them that money. And that's not the case. The bank is only going to loan you the money on what the home is appraised for. Now, with that being said, if you have a purchase price of $500,000, the home price is for $540,000, they're not going to be $540,000. They're only going to give you the appraise or the purchase price. But as we're thinking about this, these are the conversations that we need to be educating people for, is that if we get into multiple offer situations and you're having to do something to make your offer look more appealing, and we're pulling the different levers, right? We're contingencies that we're waiving, or we're having to bring more money out of pocket. Does that impact them in a negative way for the future, right? If I have $20,000 less in my pocket, $30,000 less in my pocket, or maybe I don't even have that kind of money, does it make more sense to purchase knowing that I might be paying an additional $100 or $200 a month in my mortgage payment versus doing a $20,000 hit at a one-time fee of 3 months down the road, 4 months down the road, when it gets more competitive? And again, we don't know what makes the most sense for our client until we have that conversation and we educate them. So purchase application data going up, mortgage rates staying flat. We're seeing that Arvada and Westminster, there's not a whole lot of inventory, and we don't anticipate a whole lot more inventory. So now we have to go out making sure that we're educating, that people understand that we're still at an all-time low. We are at an all-time low of inventory over the last 3 years. Yes, we're in a housing recession. It's getting better, but we've seen less and less homes hit the market. This isn't 2019, because this would be a healthy market that we see at 960,000 houses. And nationwide, we're sitting at 505,000, which is not enough for the demand that we have. And if we were to look back on December data for DMAR, right, we got like 2.5 months of inventory, maybe 3. That is not enough inventory to sustain the population of what we have. And that's what's keeping prices where they're at, and why we will not see 2008. And we need to be making sure that these crash bros and anyone else that we're having these conversations with, that think that we're going to see that ever again, that's not real. There's no world where that happens. So guys, as we do that, and as we wrap it up, any questions that we have around some of the stuff that we looked at today?